Hey marketing shooters, welcome back to the channel. We are absolutely bursting with gratitude today. A massive, heartfelt, and truly enormous thank you to each and every one of you who has helped us reach 2,000 subscribers. Like, like it's still sinking in. When we started this channel, we never dreamed to have such an amazing community. Like every like, every share, every comment means the world to us. It's incredibly motivating to know that our content is resonating with you, and it pushes us to work even harder to bring you the best possible marketing insights. Seriously, from the bottom of my heart, thank you, thank you, thank you. We know there are a million other channels you could be watching, so the fact that you chose to spend your time with us, it's something we don't take for granted. We're so excited to continue this journey with you, to keep growing together, and to keep exploring the ever-changing world of marketing. We've got so much content lined up for you guys in the future. So stay tuned for even more exciting content on the way. And as a small token of our appreciation, we've decided to dedicate this episode to you guys, our amazing marketing suit family. So grab your favorite cup of coffee, settle down, and let's dive down into some business. Today we're diving down into the latest tax news, how it could impact your marketing strategies, and what you need to know to stay ahead of the curve to be the great marketing professional you are. So let us begin.
The IRS has officially started accepting 2024 tax returns this week, which means accountants across the country are preparing for their annual hibernation, or rather, their annual sprint to meet that April 15th deadline. And while there are some important changes this year, the real fireworks are coming in 2025 when Congress will face one of the biggest tax battles in recent history. Why? Because key parts of the 2017 Tax Cuts and Jobs Act, or TCJA, are set to expire. That means tax rates and deductions and credit could all be up for debate. And trust me, when it comes to taxes, Congress isn't exactly known for playing nice. So let's rewind a bit to understand what's at stake. The Tax Cuts and Jobs Act was signed into law during Trump's first term, and it brought some big changes, including lower tax rates for 5 out of 7 income brackets, doubling the standard deduction, which meant fewer people needed to itemize deductions, doubling the child tax credit, and making it available to more families. Raising the exemption for inheritance taxes so only estates worth over $14 million are taxed. Now, here's the catch. These provisions weren't permanent. If Congress doesn't act, they'll expire on December 31st, 2025, and that could mean higher tax bills for at least 62% of Americans starting in 2026. Sounds simple, right? Congress just needs to decide whether to extend the tax cuts or let them expire. But here's where things get tricky. Keeping these tax cuts could cost the government $4.6 trillion over the next decade, according to the Congressional Budget Office. That's money that has to come from somewhere. So if lawmakers want to keep the tax cuts, they'll need to figure out how to pay for them. And that's where things get political. Let's talk about it. Republicans and Trump. They're largely in favor of extending these cuts, arguing that they've boosted economic growth and put more money in Americans' pockets. In fact, Trump has gone even further, promising new tax cuts if he wins in November. His wish list includes eliminating taxes on tips, overtime pay, and Social Security benefits, scraping the federal estate tax entirely, which currently applies to very large inheritances, lifting the cap on state and local tax deductions, a move that would benefit high-income earners in states like New York and California, allowing Americans to deduct auto loan interest, which, let's be honest, could be useful with today's car prices. But extending tax cuts without cutting spending could add to the national debt, which is already at 121% of GDP, up from 104% in 2019. So how do Republicans plan to offset the cost? Well, One idea being floated is cutting other deductions like those of student loan interest, mortgage interest, and the head of the household status that helps single parents. Another option, spending cuts. That could mean reducing funding for social programs like Medicaid and food assistance. But that's politically risky, especially in an election year. So, while Trump and his allies are sharpening their axes for new tax cuts, the real question is, who will pay for them? On the other side, Democrats aren't exactly on board. They argue that many of these tax cuts primarily benefit the wealthy and corporations, and they'd rather see reforms that help lower and middle income families. Instead of extending all of the TCJA provisions, Democrats might push for an even bigger child tax credit to help working families, higher corporate tax rates to offset revenue losses, keeping deductions for student loans and home ownership intact. And let's be real, there's zero chance both parties are going to see eye to eye on this anytime soon.
So what does this mean for you? Well, if Congress doesn't act, you could be paying higher taxes starting in 2026. And if we do extend the tax cuts, expect major debates over how to balance the budget, because there's no such thing as a free tax break. But taxes aren't just changing for high earners. Small business owners and side hustlers, listen up. The IRS is making it way easier to track your income on platforms like Etsy, eBay, StubHub. If you made at least $5,000 selling goods and services in 2024, you'll likely get a 1099K tax form. And by 2026, that number drops to just $600, meaning more sellers will be on the IRS radar. And before we wrap up, let's talk about one of the weirdest tax policies out there. India's new popcorn tax. Yep, the government created a 3-tier system just for popcorn. Loose popcorn with salt, 5% tax. Pre-packaged popcorn, 12% tax. And caramel popcorn, 18% tax. And don't even get me started on movie theater popcorn. It's taxed differently if it's sold with or without ticket bundles. Confused yet? Bottom line, taxes are complicated, and 2025 is shaping up to be one of the biggest tax debates in years. Stay informed, plan ahead, and if you're selling stuff online, maybe set a little extra aside for Uncle Sam. What does that mean for marketing professionals like us? Well, a lot actually. Client budgets will shift if tax rates increase in 2026 because businesses, especially small ones, may tighten their marketing budgets. That means less ad spend, fewer sponsorships, and reduced freelance opportunities. Staying ahead of these trends can help you adapt your strategies and find new revenues. E-commerce and side hustles will be impacted. Platforms like Etsy, Amazon, even social media marketplace will see more sellers facing tax obligations. That could mean to higher prices, fewer small sellers, or a demand for smarter digital marketing strategies to keep sales strong. More demand for financial education content, like what we do here on the Marketing Soup. If you work in content marketing, SEO, or social media, this tax shape-up is a goldmine for engagement. People will be searching for tax tips and budget hacks and strategies to navigate new regulations. Brands that create valuable, easy to understand financial content will stand out amongst the rest of them. So whether you're running ad campaigns, managing clients, or selling your own services, this tax overhaul isn't just a finance story. It's a marketing story too. Stay informed, stay agile, and keep delivering value to your clients. Thanks again for the amazing 2,000 subscribers. If you found this video helpful, be sure to like, comment, and subscribe for more marketing updates. I'll see you next time on the Marketing.